I'm a financial advisor. I work with people around the country helping them manage their portfolios, but I'm going to explain to you how to manage your own portfolio so you don't need a financial advisor. I've been working in financial services, working as an investment advisor, if you put it all together, for going on 25 years now. And we work with people around the country that are hiring us, paying us a fee to manage their portfolios as fiduciaries. For me, that's evolved over time. Years ago, I was a broker. Years ago, it was more transactional. We used to have products like mutual funds, even real estate investments or annuities, combining all that into a portfolio. And so for me personally, our business has evolved into something that's strictly fiduciary based. When I work with somebody, we charge them a fee, a percentage to manage their portfolio. And as long as we're providing value, meaning if we can show them how to get a higher average rate of return net of that fee, we're providing value. If we can't, there's no reason to work with us. But if we can not only increase the rate of return they're getting and reduce the amount of risk they're taking to get that return, then that's even more valuable. But here's the thing, not everybody needs a financial advisor, investment advisor, broker, whatever you want to call it. So the reality is most people are hiring financial advisors or investment advisors to help them get a return because they feel like maybe they can't make the best investment decisions on their own, or maybe they feel like they don't know when to be in the market or out of the market. I think the reality is most people, when they go to financial advisors, they wind up talking to a financial advisor that's a product of their own environment. If it's a big bank or something like that, well, the big bank is sort of pushing them or incentivizing them to promote what the bank wants them to promote. If it's a big brokerage firm, same thing. There's a particular business model. Maybe it's an independent financial advisor, but they just think or feel that their particular way of managing assets is better than what everybody else is doing. The reality is anybody out there can manage their own portfolio as long as they're willing to take the time to do it. And then also not just the management of it and time to do that, but also the time to learn and just understand basic principles. So the basic principles to actively managing portfolios, as opposed to just hang in their portfolios, which I realize is what a lot of people do, is understanding your probability of success moving forward. You need to understand what is the probability of markets going higher, or what is the probability of markets going lower, or what is the probability of markets just trading flat. Now, there is no crystal ball, and nobody knows exactly what's going to happen. But what you can do, as long as you can understand and implement certain things, meaning, here's a good question. So, is the market overbought or oversold? It's a pretty straightforward question, but most people don't have that information. It's something that can be measured. But if the stock market is overbought, it's more likely to go down. And if it's oversold, it's more likely to go up. So that's something you would want to know if you're managing your own portfolio. Something else, people look at what are called moving averages. So if you look at, pick an index, the S&P 500. If you take a look at the 50-day moving average on the S&P 500 versus the 200-day moving average on the S&P 500, and you're tracking that, which of course you can do on your own, you just have to stick with it and pay attention. But if you're tracking that and historical data, what you would find is that if you're tracking the 50-day moving average and the 200-day moving average, when the 50-day moving average drops below the 200-day moving average on the S&P 500, the probability that markets crash is pretty high. It's not guaranteed, but it's pretty high. And so one of the ways to look at that would be to say, well, the market doesn't always crash when the 50-day moving average goes under the 200-day moving average, but the market has never crashed without that happening. So this is data that's important. Something else you could look at is what's called MACD. So MACD is another way to take a look at those moving averages. It's just measured in a different way. The point is, if you're going to manage your own portfolio, it's really not that complicated. You just have to spend some time getting data, and that data is available online. Understand, are the markets overbought or are they oversold? understand what the moving averages are doing, and then understand MACD. It's not a guarantee, but if you're retired or close to it, and you want to know when to be more aggressively invested versus more conservatively invested, then if you're taking a look at that and you realize, all right, well, if markets are overbought and the 50-day moving average is dipped below the 200-day moving average, and MACD isn't trading in the direction that you want it to go, and you realize, well, markets don't crash every time that's happening, but 8 out of 10 times when that happens, markets have crashed historically. It's not a guarantee that the market's going to crash, but you might want to make an adjustment to your portfolio. And think of it this way: what's the worst case scenario? The worst case scenario would be you were looking at these indicators, they were negative, so you pulled your money out of the market and the market went up. What would happen is you would miss out on a portion of gains. But because certain indicators can show you probabilities, again, not guarantees, but what if it saved you a bunch of money? The people that we work with are more willing to give up a portion of gains than they are to take big losses in portfolios. So if you want to manage your own portfolio, it just takes some data. And if you pay attention to moving averages, if you pay attention to whether markets are overbought or oversold, and if you pay attention to what they call MACD, it's going to get you that much closer to being just more tactical in managing your own portfolio. And so if I was going to start managing my own money and I wanted this data, I could go to different places, but basically you just want to start charting. So there's a website called YCharts. Again, I'm not advocating you can go subscribe to YCharts. I just know that you could go there and you can track things like the moving averages. You can track things like whether the market's overbought or oversold. You can track things like MACD. If you want to do it yourself and you have the confidence to do it, just empower yourself. Go out there. You'll have to subscribe, pay a little bit of money for the data. But once you have the data, and then you have your positions, once you understand more about the direction that markets are likely to move, again, not guaranteed to move, chances are you'll get a higher rate of return, and you'll be taking less risk to get that return. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.